Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. So, the market price action has been quite fascinating to start 2025. We've had extremely weak market breadth that's very similar to early 2022 ahead of the last bear market that we've experienced. We'll discuss interest rates and inflation, how those are actually very different than 2022. And then this week's reading for the AAII sentiment poll showed bearishness at its highest level since September of 2022 and the seventh highest bearish reading in history. Quite fascinating. Let's unpack exactly what the implications are from that data. Now, weak market breadth is very similar to early 2022. On the chart here, we have from December 31st, 2023 through February of 2025. That is the date the NYSE composite was right back to its all-time high. The S&P 500 made a new all-time high one day later. Large caps have been performing largely pretty well. But during that period, from that previous November peak through February 18th, rather, you can see that the S&P 400 mid-cap index, those are US mid-cap stocks, and the Russell 2000, which represents small cap companies in the US market, they were down 4% and 6% respectively. So we saw some weakness underneath the surface, and market breadth overall was quite weak ahead of that market top, which preceded some of this recent volatility that we've been experiencing. Now, that's very similar. This is actually a chart where we went back in time between June 2021 through January 12th, 2022. Why do we pick this time period? Well, as a reminder, January 12th was the peak for the NYSE Composite Index. That was about 6-7 days after the S&P 500 had peaked. But take a look at the price action and patterns. Extremely similar. We see the NYSE Composite making a slightly higher high, and at the same time, mid caps were down nearly 4% and small caps were down nearly 11%. So market breadth participation, very weak underneath the surface. We typically like to see broad participation in uptrends with confirmation from small caps and mid caps. We don't have a chart of it, but the advanced decline line that also measures market breadth made a lower high as well. All that is to say, the market was being supported by fewer and fewer stocks when we peaked, and ultimately that selling became more widespread during the past week. Now, let's do a quick compare and contrast of some macroeconomic data between the last bear market and today. And we can see some pretty interesting differences here. Toward the end of 2021, remember the market peaked in January of 22, you can see CPI inflation index, that's a 12-month growth in the price of goods and services. That was at 7%. It ultimately trended higher into June of 2022, peaking at 9%. And it's hard to fathom, but it wasn't that long ago. Fed funds rate back in late 21 was actually at 0%. The Fed had not started increasing interest rates, but the market was facing 7% inflation that was rapidly moving higher. The market was widely expecting the Fed to start aggressively increasing interest rates. We now know that they participated in the fastest, most aggressive rising rates campaign since the since the mid 70s, and to combat this inflation. And that expectation ultimately led to volatility and the bear market in the stock market overall. Today, we're in a different scenario. Inflation is at a third, so peaking at 9%, down to 3%, although there's some signs of being a little bit more difficult to get from 3 to 2 than it was to 9 to 3. Fed funds rate at 4.5%. Remember, that peaked at 5.5%, and the Fed started cutting in September of 2024. And they're in a bit of a pause period. But if you look at the Fed fund futures market, you can see that the S&P 500 is expected to cut perhaps 2 more times. So although interest rates are much higher, the Fed expectations for interest rates are not for them to aggressively hike rates like they did in 2022. And inflation is much lower than it was ahead of the last bear market. Now, the other side of the coin, we said technically we don't like this situation. Macroeconomically, it's a bit mixed. Inflation's lower, but the Fed funds rate is higher, but they're no longer going to increase interest rates. But the sentiment part of the coin is very interesting here. Warren Buffett always says, be greedy when most are fearful and fearful when most are greedy. Well, The data I'm going to share with you right now is showing that investors are far from greedy. They're quite fearful. This data is the American Association of Individual Investors. It's a weekly poll that asks their members, these are retail investors, are you bullish, bearish, or neutral on the stock market over the next 6 months? And you can see the percent that responded this past Thursday for the bearish vote was at 61%. That's the highest since September 22nd and September 29th. We had two readings above 60%. You can see that on the chart there in September of 22. Why is that significant? The bottom of that bear market that we just talked about was on the end of that quarter, September 30th, 2022. So the week of the bottom of the bear market was the last time we experienced extreme or bearishness like this. This is in fact the seventh highest bearish reading. We've only had six other times where it's been above 60% in history. All of those times, early 90s, ahead of that decade-long rally. Also, that occurred in October of 2008 and March of 2009. Does March 2009 ring a bell for any of you historians out there? That was the month of the market bottom, probably one of the greatest buying opportunities in the history of the stock market after the financial crisis. So bearish extremes are pretty good opportunities. And if we take a look at this chart here, we can see some stats that also support that. We went back in history and looked at since 1987. That's the history of these polls. When we're in the top 1%, which is historically above that 57% marker, you can see above average returns. So extreme pessimism, remember Buffett, fear, you want to look for those opportunities like right now. Extreme optimism, the opposite. That's when you see that greed, you see underperformance 12 months out. So sentiment is supporting the continuation of this bull market. Weak market breadth, still a little bit of a concern. So we've got some mixed signals, but overall that weight of the evidence is saying that this market's not exactly like what we experienced back in 2022, when we actually had much less optimism from this poll as well. Now, let's finish this up with some interesting news from the PGA Tour. There was a PGA tournament in Florida, and Billy Horschel here, he's actually an alumni of Florida who has the mascot, the Gators, and the Gator got rid of the Gator. He, during the PGA Tour, walking between the sixth and the seventh hole, Billy was interrupted by looks like a smallish alligator there, a normal size one, it's hard to tell. He was kind of just trotting over to the course. He proceeded to take his 60-degree wedge and poke the alligator in the shoulder, and then confidently walked him down back into the pond. He said afterwards that he's from Florida. He played at Florida. He knows that gators are more afraid of him than he was of them. And so the crowd cheered and they were happy that he was able to steer him off the course successfully. So good job. I don't know exactly how he finished in the golf tournament, but he gets the vote for the best alligator security guard of all the golfers on that golf course. With that, I want to thank everyone for watching, and I'll see you next time.